unequal cash flows. What that means is that the cash flow stream does not have a pattern. So for example, you can see here there is no clear pattern, and therefore we can't use any of the models that we saw previously, whether it's the annuity framework or the constant growth framework. That would not apply in this case because once again there's no pattern. So what we have to do is we have to use the cash flow function of our calculator in order to calculate the present value of this cash flow stream, or alternatively what this cash flow stream is worth at the end of its horizon. Now the cash flow function in your calculator is really just a spreadsheet, and the connection is as follows. With a spreadsheet, we're able to enter each individual cash flow for each year, and that's the whole point of the cash flow function on your calculator. So let's look at an example. Suppose that a project is expected to generate the following cash flows over the next 3 years. First of all, it's going to cost $100 upfront, but then it's going to generate 52 at the end of the first year, 63 at the end of the second year, and 47 at the end of the third year. At the same time, we require an 8% rate of return. So using the cash flow function of our calculator, we would enter the values as follows. And again, do you see the spreadsheet analogy there? This is really a spreadsheet. So these are the columns in which we enter the values. So the first cash flow is minus 100 because when you initially undertake a project, you actually have to invest, meaning you're going to have to pay for some costs. But then once the project is up and running, you generate the positive cash flows, and there they are. You enter them. And then what we do is we tell our calculator, we hit the MPV function to notify our calculator that we're interested in finding the present value at the beginning of this project's cash flow stream. Then the calculator will say, well, if you want me to find the present value, what rate would you like me to discount these cash flows at? It's 8%. And then we hit compute, and then we get 39.47. So this would be the value of this entire stream. So this entire stream today would be worth that 39.47. Now on our website, I have a tutorial that shows you how to use your calculator, specifically using the cash flow function in your calculator. So you can have a look at that if you need some assistance in using your calculator to get this answer. Now tip, to calculate the future value of this cash flow stream, we simply take the present value and compound it by the number of the periods. And here's what I'm getting at. In our first exercise here, what we did is we took this cash flow stream and found out what it's worth today. But let's say the examiner wants to find out what this cash flow stream is worth at the end of the 3-year period. So rather than looking at all these cash flows and trying to find the future value, if we already have the present value of this stream, so this one number here, which is 39.47, this 39.47 already captures all these cash flows. It's already built in. So rather than looking at these individual numbers again, why don't we just look at the 39.47, because it captures that entire value, but that's the present value. Well, if you want to find out what it's worth at the end, then you take this 39.47 and then you just compound it forward for 3 periods. And that's exactly what we're doing right here. We take that present value and we compound it at 8% for 3 periods. So therefore, that project cash flow stream will be worth 49.72 at the end of the 3 years. And you could see over here, basically repetition of what I discussed. We know that this entire cash flow stream today is worth 39.47. So if we want to find out what it's worth in the future, we just take that 39.47 and bring it forward 3 periods. So summary, to calculate present value, we select the model that matches the cash flow pattern in the question or in the problem. So that's how you select the model, ladies and gentlemen. It's based on the cash flow pattern. And we've seen all these in the previous module. So if the cash flow stream exhibits an annuity pattern, meaning the cash flows are constant for a finite period, then we use our time value elements in order to calculate present value. On the other hand, if we have a perpetuity, which is what these two are, remember with perpetuity there's two scenarios. The cash flows grow at a constant rate, so we use this framework. It's called the constant growth model to find the present value. On the other hand, again, they're both called perpetuities because they don't have any maturities, right? But what distinguishes them is the growth rate of the cash flow. Here there is growth, but here the growth rate is 0. So the only modification we need to make to this framework is that growth is 0. So it just disappears. So therefore, this framework over here simply collapses into just cash flow over R. And notice that we don't need a subscript here, so we don't need to know if it's cash flow 1 or cash flow 50, because with the no growth scenario, all the cash flows are the same, which is how we get this. Now the final scenario where we need to calculate present value is a scenario in which the cash flows are unequal. In other words, there is no pattern. And if that's the case, we simply use the cash flow function of our calculator. And as we said before, the cash flow function on your calculator is really a spreadsheet that allows you to enter each cash flow individually. And then we use the cash flow function in order to calculate the present value.